Good morning, everyone. Tim Nyland here. Today is Wednesday, December 23rd, and this is our weekly strategy call for Zacks Professional Services. Each week, we focus in on what's moving the market, interesting trends, and investing opportunities. If you have a topic you'd like me to explore in a future video, please leave me a comment below. You can check out previous strategy calls on our channel, and you'll also find many more videos on investing and making the most of Zacks Pro platforms. Don't forget to hit the subscribe button below to make sure you never miss any of our future calls. Today, we're going to take a pause from the hyper growth strategy series that we started on December 2nd, and we're going to discuss one of my favorite events that takes place 4 times each year, and that is the Earnings Certain Family of Portfolio Quarterly Evaluation and Changes. So let's get started by looking at the Earnings Certain Family, also along with that, the supporting equity select lists, both of which we maintain in the Zacks research system and in Zacks Advisor Tools. We're going to start out today's discussion by taking a look at 3 of the broader market proxies, one of them being the Zacks Standard Industrial Proxy, from which all of the Earnings Certain Family of Portfolios is derived from. First thing I want to mention here is obviously the S&P 500. And the Earnings Certain Family of Portfolios itself actually started out now 27 years ago, roughly. I've been involved with the design and management of the Earnings Certain Family of Portfolios its entire existence for nearly 27 years. And obviously, we set out to solve the problem that the S&P 500 inherently has, which is all of this underlying earnings variability. So if you aggregate all of the underlying companies in the S&P 500 together, you get what reflects the actual economic cycles for the United States. So you can see we get these earnings troughs, we get these rises, we go through recessions. And the idea is, as investors and as financial advisors, if we are benchmarked to the S&P 500, we may still be able to outperform the S&P 500. But if you're closet indexing to the S&P 500 using the spiders and SPY and other ETFs that mirror the S&P 500, we have to ask ourselves, are we really doing our clients any justice by dragging the underlying companies that they hold through these recessionary troughs? In other words, is there a way that we could design a portfolio and not have to worry about trying to time these recessionary periods? Because we don't know when they're really coming. I mean, we got an idea, but we don't want to necessarily be in the market of trying to time the market itself. What we would like to do is build a portfolio where we can rely on just a constant, steady earnings stream for all of our underlying holdings. And we certainly don't get that with the S&P 500, okay? If you're a fan of what many would consider to be the more conservative S&P 500 Dividend Aristocrats ETF, this is Noble, very popular. Again, the idea here is these are the aristocratic companies in the S&P 500 that have a history of continuing to increase their dividend each and every year, and on and on and on. That's great, but you're giving up a lot of performance for that yield. And you can see that that particular group of companies as well is subject to some pretty significant earnings troughs through recessions. And we're dragging our client portfolios through the mud, literally in terms of performance and loss of capital during these time periods. And so I'd like to go ahead and introduce the Earnings Certain Family once again. We'll go through this very quickly. But the way that this process all started out 27 years ago is that we had to basically disaggregate the S&P 500 down to begin constructing a portfolio where we could forecast where earnings were going to be with literally 95% certainty 1 year forward. And in order to do that, we would have to design a portfolio where this orange trailing 4 quarters operating earnings line would literally be as straight as possible for upwards of 25 years historically. Okay, there's a whole methodology behind this. I'd be more than happy to spend any amount of time we need to with anybody that wants to reach out to me. A separate strategy call offline, we can go through the whole process. But at any rate, we took the S&P 500, we stripped out what we call all the tilt sectors, where you literally own one stock, you own them all: financials, energies, precious metals, commodities, there's a bunch of others. And when you do that today, you end up with about 250 stocks. We added back a like 150 outside of the S&P 500. This can come from the Russell 1000. It can come from virtually anywhere that meet our criteria. And that's where we end up with the standard industrial portfolio of 400 stocks. Now, I'm going to back up for just a minute to the prior two, and I want everybody to just kind of pay attention to how similar the price action looks and the earnings action looks to the broader proxies of the S&P 500. So we're going to go previous one slide to the Noble portfolio. You could hardly see the difference when I change the slides, right? Same type of exacerbation of the economic cycles with regards to these earnings troughs. And if I go back even one more to the S&P 500, don't blink because you'll miss it. It looks very, very similar. So all we did here with the standard industrial portfolio is we stripped out the baskets of securities that tended to skew the market in terms of causing these massive recessionary earnings troughs the most. And then from there, we more or less fine tune our process. So we basically take these 400 companies in here and we rank them on earnings stability. And if you do that today, you'll end up with roughly 200 of them in the cyclical portfolio. And this is where I do all my research regarding valuations on cyclical stocks. And so if you go through the prior webinars that we've been doing, and if you've been in on any of my strategy calls, anytime somebody asks me about anything cyclically oriented, this is the very first screen I go to. And then I always take a look at bellwether cyclicals like Caterpillar and Deere. Even if I'm looking at home builders, I don't care. I always use this as my compass, my north point. And I would recommend that everybody do this, right? Because this is your litmus test for how this entire basket of cyclical stocks, those that are most sensitive to the U.S. economic cycle, are behaving relative to their underlying forecast earnings, specifically in aggregate. The flip side to that are the 200 names that are the most earnings stable. And you can see a stark contrast. Now we start getting into the growthier portion of the U.S. economy. So if we go back here, again, 2 slides, the standard industrial portfolio, 400 stocks, that in my opinion is the best proxy or pulse of the U.S. economy, not the S&P 500, okay, but the standard industrial portfolio. Why? Because we don't have all those tilt sectors in there that are skewing the portfolio and skewing valuations. So we split that into the cyclical portfolio. Again, my preferred proxy for doing analysis on those companies that are most tied to the underlying economic cycle. And then the 200 most earnings stable stocks in the growth portfolio. And you can see that here. Now, if we move forward to the 75 most earnings stable out of the Zacks growth portfolio of 200, now we start talking about the earnings certain core portfolio, or what we refer to as the core 75. This is the original earnings certain core portfolio. And you can see that with this portfolio, we've essentially solved the problem that we set out to do years ago, which is design a better mousetrap, if you will, than the S&P 500 in terms of not dragging our client accounts through those recessionary troughs with regard to earnings. And therefore, if we can protect the underlying corporate earnings during recessions, it then minimizes the downfall or the loss of principal to our client portfolios or to our own investment portfolios. And we can recover faster and harder out of the recessions and continue to compound those returns over time. And that's what you see with the earnings certain portfolio. Okay. And what I want you to see here is these estimates, right? The earnings certain portfolio traditionally returns about 11.5% compounded annual growth for 25 to 30 years. And you can see that forecast growth is right in line with 11.5%, 12.5%, or here's 12%, 11%. We're coming out of the trough. The issue here is we've got a little bit of a dip with the earnings certain portfolio. Again, 75 stocks. When I did the analysis back in March, when the COVID crisis hit, we ended up with 45 companies in the earnings certain portfolio that were subject to some sort of reopening phenomenon. Okay. So in other words, if we were to shut down the entire U.S. economy, which we did, I quickly found that there were going to be 45 companies in the earnings certain portfolio that were going to be subject to a reopening phenomenon. And those companies, along with the Admiral stocks, which we'll talk about in just a second, comprise the entire 75. You can see what that earnings line looks like in aggregate. We have just a slight dip, and then we revert right back to trend. Okay. So welcome the earnings certain core Admiral 30. Okay. This is the portfolio that we get when we strip out those 45 stocks from this particular earnings certain core 75 that were subject to some sort of reopening phenomenon. And I want you to see how good of a job we did with this portfolio, because it's practically unheard of to be able to design a portfolio in advance of COVID, where we were actually able to not only sustain earnings growth through the COVID shutdown, the Admiral portfolio was able to grow earnings. In other words, earnings growth actually accelerated. You can see that we've got actually a little bit of a rise in trend before we get back to trend. And you can see we've got 10%, 8%, 12%. If you go back to the previous slide, the reopening phenomenon here, we've got 2%, 12%, 11%. So still on long-term trend to be around 11.5%, but doing it just a little bit differently. Okay. The Admiral 30 stock portfolio is the ideal core portfolio for a multitude of reasons we'll get into here in just a minute. The Zacks Earnings Certain Core Dividend Aristocrat portfolio. This is 25 of the highest yielding companies out of the core 75 portfolio. And you can see that it does mirror that same earnings certain 75 characteristics of just a slight dip, and then we revert back to trend. Okay. A little less growthier oriented of a portfolio, as you would imagine, because we've got a higher yield. Okay. Earnings certain family, again, we talk about the core equity tilts. For anybody who is a current subscriber of ECP, it is a slight upcharge to actually get access to the earnings certain portfolios in Advisor Tools. And if you are subscribing to the earnings certain family of portfolios, you'll know from watching the videos and speaking with me that a core portion of the portfolio requires us to tilt. Okay, and that is, in other words, what we do here with the tilt portfolio is we manage our upside returns in up markets. So this is a way for us to add basically beta to an otherwise extremely defensive strategy with any of these portfolios. So if you take the earnings certain Admiral, the most common weight that we see out there is about a 20 to 25% weight. If you go back to the core 75, we're looking at 30+% weights on average. And that literally is what it takes to bring the technology sector weights and communication sector weights up to being in line with the S&P 500. Again, what we do with the earnings certain family of portfolios, we do nothing related to trying to mirror any sort of sector allocation relative to the S&P 500. Anything that just happens to be is literally a byproduct of the process. So the only thing that we're doing is we are literally managing this portfolio to the concept of this earnings stability. There's a lot of other fundamental factors involved when I go through the analysis each and every quarter. I do analyze all 400 stocks, and I go through the entire process, making sure that the financials are consistently stated, that we've got the track record and history we need to do the analysis. But what I want everybody to take away from the core equity tilts is it adds to the returns, it adds to the beta in up markets, still giving us good defense in the down markets. But what I want everybody to focus on is this growth that we get in up markets, right? So earnings growth in FY1, 19%, 21%, 43%. So we've got growth acceleration. So when we couple the tilts with the core positions, we're able to capture this accelerated growth. And that's what we're after with that tilt portion of the portfolio. And if you watch my webinars, you'll learn a lot more about that. But there's 6 stocks in the tilt portfolio. And if you were to compositize these in aggregate, this is what the price and earnings look like. You'll see that they have the same recessionary proof characteristics in aggregate, and they have triple to 4 times the amount of underlying earnings growth. So it definitely helps get us that beta and get us that growth to make sure that we continue to outperform the S&P 500 even in up markets, because we know we outperform the S&P 500 in down markets, and we'll see that here in just a minute. So the earnings certain family rebalance for the fourth quarter of 2020 is complete. I completed it last week. And out of the supporting portfolios, we call these our equity select list. Everyone gets access to these in advisor tools as well as the Zacks research system. Many changes to the standard industrial portfolio. I've reclassified several stocks in the cyclical and growth portfolio. We're not going to go through all these today. These are changes that I make each quarter during my evaluation of all 400 names. So these are my additions. So the membership count stays the same across all of the equity select lists. So that's your standard industrial portfolio, your cyclical portfolio, and your growth portfolio. And then we get down to the Q4 2020. I call it a rebalance. It's really not a rebalance. For those of you that are following the strategy, you know that a minimum of once a year is all you really need to do. I call it a rebalance. It's really changes to the portfolio quarterly. The earnings certain 75 core. We've got a situation with Omnicom Group. After watching it for several quarters, it looks to be broken growth now. I pulled it out as an ECP member. And I really want to spend some time on what I did with JM Smucker and General Mills, right? Because out of the ECP Admiral, I removed these two companies. They are spectacular companies. They are earning certain members of the core 75. But I went ahead and removed them out of the Admiral, and I'll show you the charts here in just a little bit, in favor of some higher growth candidates to help smooth out the trajectory of forecast earnings growth. Again, one of those things that we're doing just to fine tune the portfolio as we come out of this COVID era. It's going to help us with our upside returns. A lot of the demand for JM Smuckers and General Mills was pulled forward. We're going to see that in terms of the growth. I'm going to show you the charts here in just a minute. No changes for the Dividend Aristocrats and no changes to the Tilt portfolio for Q4 of 2020. So the additions to the earnings certain family is we've pulled in just an absolute bellwether material stock by the name of Ball Corp. And for those of you that are old timers like me, yes, it's the Mason Jar company, but they are probably one of the world's largest packaging companies. They've got an aerospace arm with their aluminum manufacturing, and they cover just an absolute ton of ground. We're not going to talk about exactly what they do, but we're going to look at the charts here. They're replacing Omnicom in the core 75. And when we start looking at the ECP Admiral, you'll see why in a minute I chose Monster Energy to replace JM Smucker, and you'll see why I went ahead and moved Ball Corp right into the Admiral 2 to replace General Mills. Again, nothing wrong with General Mills. There's nothing wrong with JM Smucker. They're still in the core 75. The only reason I did this was, again, to fine tune that growth trajectory for us as we move out of the COVID era into 2021. Okay. So here's Omnicom Group, and you can see I've talked about what it means when these price lines end up crashing down to the earnings line. Very little faith in management's ability to deliver on these numbers. I went ahead and made the move now, and you'll see why here in just a minute. But Omnicom is out, and this is the reason why. Okay. And so welcome Ball Corp. And you can see, obviously, its growth is absolutely spectacular, 16%, 13%, 17%, but just does an excellent job at being able to maintain that earnings trajectory, specifically through COVID, with the demands for consumer goods and packaging. We see this with several of our other materials names in the ECP as well. Ball Corp, just a real winner here. And so we're adding it into the Admiral portfolio. This is basically the earnings certain proxy with Omnicom Group in it. And again, it's 75 stocks. So, we're looking at this with Omnicom. So this is how it stood before the changes, 2, 12, 11. And then when we add Ball Corp in here, it just literally smooths it out to just a straight 11%. You're really not going to be able to see much in terms of changes yet, but the addition of Ball Corp is going to be a winner for us long term in that quest for earnings stability. When we look at the earnings certain Admiral 30, we look at the removal of JM Smucker. And if you recall from the Admiral 30 price and earnings chart that I showed everyone here just a minute ago, and we're going to look at it again, but we actually grew earnings through COVID. And there are two names that contributed most to that earnings growth. We actually pulled growth forward from future years, actually. One of them was J.M. Smucker and one of them was General Mills. And you can see the growth that we experienced here. And the interesting thing is the buy side really didn't pay up for a lot of that growth. Why? Because the buy side knew that it was pulling that growth forward. In other words, those trend rates were kind of a one-time, and then we're going to see those growth rates taper off. And you can see that happening right here. So -2%, -4 after this massive run-up, okay? So there's definitely a little bit of room here for us to make a strategic move in the Admiral portfolio and shift gears into fine-tuning this growth trajectory to something that's a little bit more upward trend and perhaps even a little bit more stable. Again, nothing wrong with J.M. Smucker. This is why we held it in the COVID downturn. It gave us a really, really nice defensive position in that underlying earnings stream, and it met the objective. Same thing with General Mills. Okay, you can see that playing out here. So welcome, Monster Energy. I don't think this name really needs any introduction. If anybody's into adrenaline sports or drinking energy drinks, you know who Monster Energy is. They sponsor every adrenaline sport event in the world, and you can see what that marketing does for them. A solid, literally solid 14% growth, just year after year after year after year. So blazing right through COVID, blazing right through the Great Recession, Monster Energy just continues to perform. We pay up for the quality, we pay up for the growth, we pay up for the consistency of the earnings. And same thing with Corp, 16, 13, 17. So this is the earnings certain Admiral 30 with J.M. Smucker and General Mills. 10, 8, 12% growth. This is the way it stood prior to the changes. And you can see this uptick in growth here, and then we normalize out. And then when we look at the earnings certain Admiral with Monster Energy and Corp in its place, you can see we go from 10 to 9 to 13. So we're going to smooth out that trajectory. And then those two stocks out of the 30, it actually will help to continue this historic trajectory of nearly 12% growth that the Admiral has had for roughly 25 years. And that's a least squares growth rate. Okay. So what I wanted to do is just kind of summarize again for everybody on the phone. We're going to have a lot of clients looking at this, and obviously a lot of prospects as well. The earnings certain family of portfolio plus those tilt strategies, again, the earnings certain family is available for upsell in Advisor Tools. So it's not included in the base subscription, but for just a couple dollars more, you can have it in our premium subscription. And it's an ultra long-term buy and hold core equity portfolio that's literally managed to earnings stability. And there's a whole science behind it. More than happy to walk through it again offline with anybody that needs it. But I want to make sure that everybody understands that the following here, I've got byproducts literally bolded and in all caps. This is all really a byproduct of a process that's been in place with no changes for roughly 27 years. And I've been involved with the management of this portfolio for that entire time. And it has a 25 plus year track record, like I just mentioned. And on average, your Sharpe ratio is literally 2 times the S&P 500. So that means when you adjust the returns for risk, you're returning roughly 2 times the S&P 500, which is just spectacular. Because what that does, it allows you a lot of liberty in your tilts that you apply on top of your core equity strategy to provide additional alpha. Okay. On average, the downside capture is roughly half the S&P 500 over the past 180 months. So that takes you right through the Great Recession. This portfolio was down roughly half the S&P. On average, the ECP outperforms the S&P 500 in down markets 80% of the times. And again, that observation period is literally 180 months. Turnover remains very low. It's averaging roughly 7% over the last 180 months. We don't like to make changes to these portfolios, right? These are long term. We like to know where earnings are going to be 1 year forward with 95% accuracy. So if we're constantly turning over the members in that portfolio, that's going to skew one of our objectives. So turnover has to remain low. Standard deviation and beta are both much lower for the ECP family than the S&P 500. And when we look at profitability, right, in terms of return to common equity shareholders and a variety of other metrics that I love to look at, you can see these on my strategy calls. When I show these charts, on average, we're looking at 1.5 to 2 times the S&P 500 in these underlying members' ability to compound capital. Even when we aggregate that as a group, we look at it as a composite. It's literally 1.5 to 2 times. So your ROA, your ROE, your free cash flow return on investment, all these things that we look at, the ECP portfolios just absolutely crush the S&P 500, and they've done it for 20 years or more. So you get all this peace of mind and all this performance efficiency, and it can be purchased for roughly the same valuation as the overall S&P 500. So this is where I scratch my head as I talk with advisors about this. If you were to have to choose between the SPY or the Admiral Portfolio, why would you pay more in terms of valuation for the S&P 500 in terms of a forward PE multiple, and you can actually invest in the Admiral for a lower PE and get all the benefits that you get with this 30 stock portfolio instead of buying into a 500 stock portfolio that has a lot of characteristics associated with it that are just not ideal. When we look at the earnings certain Core 75 portfolio versus the S&P, it's a little bit more expensive, but it's always been that way. Again, we're paying up for quality, we're paying up for earning stability, and it's worth a little bit extra, not much, but a little bit. Same thing with the earnings certain Dividend Aristocrat 25. It's always been a little bit more expensive. It is just a touch more expensive now. But again, think of all of the additional benefits you get with that portfolio. That's about all I have for this week. And I'm available. Just reach out to me via email if you'd like more information. You can also contact our support line, contact your sales rep, email us at advisortools@zacks.com. More than happy to assist with any questions. This deck can be requested. We'll go ahead and email it out to you if you go ahead and send us an email. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. Thank you for watching, and I hope to see you all next Wednesday for another weekly strategy call. Next Wednesday, we're going to be tackling the semiconductor space, and I'm going to be unveiling my framework and strategy for basically tackling the semiconductor space for the next 5 to 10 years using only 4 stocks. And I think you guys will find that more than fascinating. So I'm going to be on vacation next week, but I've already pre-recorded the webinar, and it's set for release next Wednesday. So be sure to subscribe and tune in and enjoy. Happy holidays to everyone, and we will catch up with you soon. Thank you.